Day 3 of the Trading Bootcamp. Day 2 was about trend. Day 1 was about discipline, and today's gonna be about liquidity. Liquidity is really important because it's the reason why price moves the way it moves. And today we're gonna be going over how to spot liquidity in the market, how to capitalize off these key levels of liquidity, as well as the 3 key levels of liquidity that I look for when I'm trading. How to base your stop loss and take profit off these levels, and ultimately capitalize off what the market is showing you. So yeah, without further ado, I'm gonna get into liquidity. Let's go. Okay, so here's the charts. Before we go over here looking at price and showing you where liquidity is in price or live, I first want to tell you where liquidity lies within the market. So liquidity lies within the highs of the market, or highs of price, and the lows of price. So liquidity lies above the highs of price and below the lows of price. And for those of you who did not watch day 2, I would advise that you go check that out. I talked about price and how price is formed. So yeah, if you didn't catch day 2, then go watch that, and then you'll understand what price is. So above the highs of price and below the lows of price is where liquidity lies. So that means if I draw it out, or if I bring the arrows, the path. So you have a high, we're in an uptrend. So we're in an uptrend. If a high, talked about trend last boot camp. You have a high, have a low, have a higher high, higher and a higher low. You have a higher high, and so on and so forth. So liquidity is gonna rest. Liquidity is gonna rest above this high. It's liquidity above each one of these highs, actually. So this high, it's all areas of liquidity. That's why when price goes and takes these highs out, it retraces. And it goes and takes these highs out, it retraces every time, because it's filling orders. It's filling orders that rest above these highs. So that's what liquidity is. So liquidity is orders. I'm probably showing over this first, but liquidity is orders, or liquidity orders that rest above highs in the market and below lows in the market. What these orders are, buy and sell orders from retail traders or investors that are looking to buy low and sell high. So when the market goes higher and takes out these areas of liquidity, or takes out these highs, orders are being filled at the top of this move. Orders are being filled, and retail sellers are selling the market, or they're selling price and forcing price to go back down, because they're getting in at a premium. They're getting in at a more expensive price to sell, which means they made money, or they are getting in below the lows. They have an order below the lows to get in at a cheaper price in order to make more money when price goes back up. And that brings me to my next look on liquidity, which is in a downtrend. You can have liquidity in an uptrend. You can have liquidity in a downtrend. So you have a low, a high, a lower low, a lower high, a lower low, and a lower high, and so on and so forth. And so, where's liquidity rests within this? Liquidity rests below these lows, below this low, below this low. And what does market tend to do when it sweeps liquidity under these lows? It tends to retrace. It sweeps, retraces, goes back up. Sweeps, retraces, and goes back up because orders are being filled from those retail traders, from those investors that are looking to catch the best prices to invest their money. So now that we have that out the way and we understand what liquidity is and where it lies within the market, I now want to go over the three main pieces of liquidity that I look for within the market that really help me with my trading strategy. So let's put those on the screen. Three key areas of liquidity. What are these three key areas, you ask? Session, highs, and lows. That's one. Two, Newsweek, highs and lows. And then three, relatively equal highs and lows. So let's break these down. So session highs or lows are just basically based off the different sessions of the market. You have Tokyo Asian session, Tokyo or Asian session, you have London session, and you have New York Stock Exchange Open and New York session. So if I pull up my trading sessions indicator that I use, you can see here. So this orange is London session. So the highs of London session is a key area of liquidity. The lows of London session is a key area of liquidity. This blue area here are Tokyo or Asia session. This high is a key area of liquidity. Let's mark it out. Asia session highs, right, in green, and then below you have Asia session lows. We're gonna put this in red. Asia session lows, and the same thing for London. So we mark it out. London highs, and then this is the low of the orange, which is London lows. So you have London highs, London lows. You have Asia highs, Asia lows, which are key liquidity grabs in the market, and which typically move the market in the opposite direction. Or forces market to retrace. So that's how you spot those. So let's get rid of these so you won't get confused. And now we have Newsweek and Newsweek highs and lows. So what I like to use for news is forexfactory.com, which you can go in here and you can see all the key news dates or key news events. So when you see, let me just filter this out because really you only want to worry about orange and red folder news. More importantly, orange folder news because it affects the market and how price moves drastically. So as you can see on May 14th at 8:30 a.m., which was last Thursday, we had red for the news. So if we go on the chart and I'm gonna hop in bar replay and see if I can go back to May 14th for you all. We're just gonna go as far back as possible. And it's thundering really bad outside, so I apologize for um, any thunder you may hear in this video. So boom, we're back. No. We're back in we're back on May 14th, and that Red for the News came out at 8:30, which means this candle here, this 8:30 candle, the bottom of this wick is a key area of liquidity, which means 9 times out of 10, once price sweeps this area, or once price goes below this area and takes it out, then it's going to reverse to the upside, which we see happen here pretty perfectly, and it's a pretty big move off market open. So yeah, that's that. That's one example of that. I don't really feel like going back to find every piece of news. Okay, so we can go to Wednesday the 13th, which had, what was that? 8:30 news again? Okay. 8:30 news again at 8 on the 13th. So if we go to select the bar, let's go back to the 13th at like 12. Select the bar again. Let's go to like 9:30, 9:35. So okay. If we go to the chart at 8. Oh. See if we can get a better look in like the 15-minute time frame. Okay, boom. So as you can see, this 8:30 candle, the bottom of this candle and the top of this candle is liquidity, but key area of liquidity. Key area of liquidity, which means price either wants to run down to sweep out this liquidity and move higher, or price wants to move higher first and trade down to take out this area of liquidity. Either way it goes, this is where price wants to go eventually. That's what liquidity is. That's how price moves. Price sweeps liquidity. Price goes down. Liquidity's here. Price sweeps liquidity, moves up, retraces back into liquidity, and goes higher. That's what price likes to do. So, yeah. Or sometimes price wants to trade into the areas of liquidity. It'll go sweep these highs, which we'll go over in a minute because those are really important highs. It'll sweep these highs up here and go down and still take out these areas of liquidity. So I'm just curious, if we go to bar replay, if we let it replay, as you can see, it sweeps the areas of liquidity, and this is basically live time. Sweeps, and then what does price do? It pushes to the upside. Now it doesn't push that hard to the upside just yet, but price does push the upside. And as you can see, once it takes out that key level of liquidity, price reverses, it goes, feels imbalances, and it just goes. It just goes. So yeah, liquidity is really important. As you can see, it works. And off the sweep, we had a very key move to the upside, which this is a trade I would have took. And I think I did catch this trade actually, and I think the recap is on my YouTube channel. I took this trade, yeah. The recap video is on my channel, so make sure you go check that out as well. So if we hop out of bar replay, let's get rid of this. Hop out of bar replay. We go back to where we were. Did I lose it? Oh, here we go. Let's move these over. So boom, we went over the session highs and lows. We went over the news wick highs and lows, and now we need to go over the relatively equal highs and lows. So relatively equal highs and lows they are pretty self-explanatory. It's when the lows are relatively like on the same level as one another. So I'm trying to find a good example of that. The good example of that was back where I just had it. I should have just stayed in bar replay mode. Okay, so as you can see here, what do we have? We have 1, 2, 3. We have 3 lows. Okay, this low is the lowest low, but as you can see, it's practically on the same level as this low. So you see how they are pretty relatively close to one another, as well as these lows right here. It's really good lows to see. They are pretty much on the same level as one another, and when price sweeps these, it pushes up. Now, in this case, it doesn't push up as high as I showed you previously with the news wicks, but it did indeed push higher. But this is a good example here because this low is low. This low is low. You always go from the lowest low when you're doing relatively equal lows or relatively equal highs. This low, key area of liquidity, which means when price sweeps this low, as you can see on the side right there, as price sweeps this low, it's going to eventually push higher. So what does price do? It goes down, sweeps, takes out all these lows, and reverses to the upside, filling imbalances and pushing higher. It pushes all the way up, and I took a massive trade off that. So I took a massive trade off that, and you can too, based off liquidity and other confluences that we'll cover in future videos down the line. But liquidity is really important, and you need to understand that because it's the way the market moves, as you can see. So if I go back, we went over the 3 key areas of liquidity: the session highs and lows, Newsweek highs and lows, relatively equal highs and lows. And these are the key areas that I use every day to catch the trades that I catch. Now I'm going to show you how to use these key areas or use liquidity to set your stop losses and take profits. So I like this example. I like the example we've been using, so I'm going to go back to that example, which I think was the 14th of May, if I'm not mistaken. Start new. Yeah, so we're going to go to the 14th of May. I trade the 9:30 New York Stock Exchange open, so I'm going to go to the 9:25 candle so I can give you a bit of a live look, which not live, but like a bar replay look of what I'm seeing in the market. So we had 8:30 news this day. We swept the 8:30 news candle, right? Which was a key area of liquidity, right? Once we sweep this low, it's no longer liquidity. Liquidity is swept, and now liquidity lies below this low, because where does liquidity lie within the market? Let me straighten this up. It lies above highs and below lows because of those retail traders, right? Cool. So once price sweeps this, and as well as it swept London session lows, as well as it swept relatively equal lows. So with that being said, I want to see price push to the upside. So as the market opens at 9:30, as you can see, price reverses and has a strong bullish push out of market open and out of the sweep of liquidity that we seen earlier. So now what am I looking for? I'm looking for confirmation. I'm looking for inverse fair value gap, which we got on the 3-minute here. And I'm looking for a fair value gap to be produced by price. So as it runs up here, and we keep going, let me go back because I forgot this is like 5-minute time frame. I need to be on 1-minute time frame. So to catch the trade, so I'm looking for this price to give me any reason to enter. Which I don't think I caught it on NQ. I think I caught it on ES. I did catch it on ES. So as you can see, price gave me my entry by filling me into this fair value gap after sweeping. This is ES, but it's the same thing. Did the same thing. Swept these relatively equal lows here, and then we had 8:30 news, which been got swept all the way up here. We swept these relatively equal lows, and then price starts to push higher, which means liquidity got filled. And as price pushes higher, it gives us entry by giving us this fair value gap. So if we go back a candle, it gave us this fair value gap, which we'll go over probably within the next two boot camps, probably the next boot camp, because they are really important as well. It gives us this fair value gap, which we're not talking about right now, so I'm not gonna out of fog FVG, which I'm not gonna talk about right now because we're not getting into that. So as price gives us this fair value gap, we have a place to enter, as well as it inversing this fair value gap. We have a place to enter, and we have a reason to enter. So now we enter the trade off the 1-minute time frame. We enter the trade. We want to buy. Let's just say we want to buy 10 contracts. We buy 10 contracts. Where do we want our stop loss to go? What's rested below this low? Liquidity. So we want our stop loss to go below previous areas of liquidity. So the most previous area we have is New York Open low, which swept liquidity, which made more liquidity. See, it's just liquidity's everywhere in the market. And what do we want to target? We want to target the higher levels of liquidity. So what's rested higher? We have, hold on, move my stop loss below this area of liquidity. And then we have what? We have these up here. What's this? A session high. We have session high up there. So what is a session high? A key area of liquidity. So now we have our stop loss rested below previous areas of liquidity, and now we're targeting with our take profit key areas in previous areas of liquidity. So if we go and we let this trade play out, let's see what happens. So it perfectly fills this fair value gap with this green candle. We're filled in our trade and we're ready to go. So as price moves, goes up, and just like that, a full take profit. And before a full take profit, targeting something that happens in the market so often, liquidity. That's what we're targeting. We're targeting session highs. We targeted session highs, and we placed our stop loss, risking minimal. We placed our stop loss underneath areas of liquidity to give price room to breathe without risking a lot and with making even more. So that's why liquidity is so important. Let me give you one more example of this in another trade I took, which was the day before this. So if I go to bar replay, select bar, then I go 9:30, because that's what I trade, the 9:30 open. This looks kind of wonky. Let's see, what candle is this? 9:29. What candle is this? 9:25. So what I like to start out by doing, let's go to M&Q and see if we get a better look at this. What I like to start out by doing is marking the areas of liquidity, which is, what is this? This is London lows, which is a key area of liquidity, as well as this area of liquidity, which has already been swept, which is 8:30. We had an 8:30 high impact news candle. So with it already being swept, price might want to go and run higher. And what am I going to target? I'm going to target these areas of liquidity up here. We have a relatively equal high. We have another relatively equal high. Oh, I didn't mean to do that. Another relatively equal high. and we have London highs. So we have three main key areas of liquidity stacked on top of each other. When you have liquidity stacked on top of each other, it's called low resistance liquidity. I didn't go over this because it's similar to relatively equal highs and lows. So I just thought I shouldn't have to go over that. But when you have liquidity stacked like this, it's called low resistance liquidity, and price loves to run and take out those levels of liquidity. So we have London lows, which may or may not be swept. But we have this news candle, which already got swept. So we're looking to see what price wants to do off of market open. And if we fast forward, let's see what happens. So price instantly runs down. Instantly. What does it do? It grabs that London low and takes out that key area of liquidity. Now that it took out this key area of liquidity, we're looking for confluences to the upside because we know liquidity is swept and we know price wants to reverse. So 3-minute time frame, as you can see, price reverses. I mean, you could have entered off this. You could have entered off this, reversing this 1 minute. I like to wait for more confirmation from the higher time frames. So we wait. So why you wait? Price reverses again. And what does it do? Wait, let's take a second to go back and see what's produced off this move down, off these three candles. So off this move down, fair value gap is produced, which we'll cover in probably the next boot camp because it's very important. This fair value gap is produced, and as we can see, price goes up. We want that fair value gap to be inversed, as well as price left behind these relatively equal highs. Now these two stacked on top of each other are relatively equal highs, so now we can target those areas. So now you have 1, 2, 3, 4 take profit areas that you can target. So we're waiting to see this gap fully get inversed before we do anything, because we want to see confirmation from higher time frames as well. So finally, we get the inverse that we were looking for, and price wants to go higher. Now let's scale down to the 1 minute time frame and see if we can get in on any entries. So now we can get in on this inversion. We can get in on these fair value gaps being produced and taken out, as well as this fair value gap being inversed. And now we're ready to enter our trade. I chose 10 contracts for this trade. I have a $100,000 trading account. So 1% of that account is $1,000. So I can afford to risk $1,000 a trade. Where are we going to place our stop loss? 1 minute time frame. Below this low. Below this low, because what lays below this low? Key area liquidity. What are we going to target? We're going to target this high, which is liquidity. All these black lines I'm marking is liquidity in places you can target. This high is liquidity. That's our first take profit. This high, which is more liquidity. And if you want to be a go-getter, you can go all the way up to try to target these areas of liquidity. Sometimes price runs all the way up there. Sometimes price doesn't. But price will run higher because we swept liquidity. So if we press go on our replay thingamabobber, as you can see, what does price do? Let's see what price shows us. Just in this line, show it being hit. Let's turn it to green, actually, to show that it's a take profit. Let's turn all our take profits, or 2 take profits, to green. Take TP1, TP2, 3, 4, 5. 5 TPs if you want. So price is chopping. Boom. Smacks TP1. What you can do here, and what I like to do in these situations, is sell half of my position. So I'm selling 5 contracts now. Selling 5 contracts. So we just took $500 in profit. Our take profits are still in these highs. Our stop losses, however, are minimal. So our stop losses are at break even. So now this is a risk-free trade, and we're still targeting areas of liquidity. What was this area? Relatively equal highs. Relatively equal highs. What is up here? Highs. It's liquidity. Liquidities rest above highs. Nothing in the future has came to sweep out these prices until now, which means there is liquidity. If price hasn't came to claim these areas, they're still valuable areas. So let's see if price continues to go or doesn't. It doesn't matter anymore because we're at break even on our trade, so we can't lose money. We got stopped out, but price came and tapped into this area of liquidity, swept it, and you were able to take $500 profit on that trade. So that's pretty much the rundown on liquidity for this bootcamp video. Thank you all for watching. If you enjoyed this video, make sure to like, comment, subscribe, as well as turn on post notifications so you never miss a video like this. As well as in the comments, leave if you have any questions or want me to cover a specific concept next in another bootcamp. If you want to be a part of a trading community and trade live with me, as well as grow with other people in the community and don't have to go through this trading journey alone because it's a rough one, I would advise that you join the Income Architects Discord listed in the description down below. Lastly, make sure to check out the other bootcamp videos. It will help you understand price and certain concepts I may have went over in this video. As always, it's been a pleasure, and peace.